In our last lesson, we focused on the basics of what stock was, and if you were the company that was going to go public and trade stock, how you would figure out what your value of the company and your value of those stocks shares were worth, and then if you had any dividends, what the value of those dividends were worth. Today, we're going to be discussing how the stock market works in the real world. We'll look at the history of the stock market, the Dow Jones Industrial Average, what a bear and a bull market are, when to buy and sell stock, and what can affect the prices of stock.
Go up, they go down. Well, Dave, I'm scared of the stock market. I don't know what it's going to do. I don't have any idea what it's going to do. Well, I don't either. I don't have any guarantees. I will tell you this. I've studied it in detail, and Ibbotson, which is one of the research firms, I pulled up all their research on it, and 97% of the 5-year periods in the stock market's history have made money. It means if you leave it alone 5 years, based on history, 97% chance you're going to make some money. 100% of the 10-year periods have made money.
So again, in the last 5 years, 97% of the time, the stock market has made money. And the last 10 years, that's 100% of the time, which just means that this is not as risky of an investment as it seems. And it's also a reiteration of the fact that investing is for long term, over 5 years versus our under 5 years, which is savings.
Yeah, Dave, but what about disasters and all that other thing? It's a very interesting question. Very interesting question. This is a study right here I hold in my hand from the Dow Jones firm. They are the people, one of the things they publish you see on the news all the time, the Dow Jones Industrial Average, right? Have you ever heard that as a measure of what the stock market's doing on the news?
So as Dave says, the Dow Jones Industrial Average is a really great indicator of how the market is doing. It was invented in 1884 by Charles Dow, which is how it got its name. And it takes the biggest and the brightest and the best companies and it averages what they're doing in the stock market together. And so when you hear the words, where did the market close today? They're talking about the Dow Jones. You'll hear that a lot on the news. And it is tracked second by second in the real world, and it's got just a ton of different companies. So you can look this up at any time. If you head over to Google and you search the Dow Jones, you'll see it kind of popped up there. Today, when I'm recording this, the Dow Jones you'll see is up by 110 points, which is really good. And you can look at the Dow Jones over the course of different things. So if I look at it over the course of this past year, we'll see that it started pretty low and it's been on the rise. If we check that 5 years, where Dave was saying on average in 5 years, the stock market is making money, you'll see that it is. It's this average upwards climb. So I've always enjoyed this clip from Futurama. It's just kind of a funny spin on how people look to the Dow Jones to determine how the stock market is doing and whether or not we should be investing in companies or not.
Ooh, ancient Wall Street.
So you saw when the Dow went down, everybody panicked and they were jumping out the windows. And then when the bell rang, which signifies the opening of the stock market again, the Dow increased and then they were all happy and everything was wonderful. And so again, the Dow Jones Industrial Average, it takes those brightest and those best companies and it says, okay, how are those companies doing? Because they should indicate for us how kind of all the other companies follow. So if I go to Yahoo Finance right now and I wanted to see the components or some of the companies within the Dow Jones, those are going to be your industry leaders that it takes a look at. So I'm seeing here, Home Depot, which is up, Pfizer, which is a medical company, 3M, we've got Coca-Cola, and you'll see overall the Dow is up today. So most of these companies are going to be up. Some of the companies are going to be down, but again, remember we're taking an average. You've got Disney, Visa, Apple, Walmart, American Express, Johnson & Johnson, ExxonMobil. So it's a variety of different types of companies, and the Dow Jones and the stocks in general, their performance will be affected by different events going on in the world. And Dave's going to talk a little bit about that.
Here's an interesting thing. What if something happened out there in the world? We would call it a geopolitical event. That was a negative thing. Maybe JFK was assassinated. What do you think the stock market did the next day? What did it do? What did it do? Right, that's what it did. What about the Cuban Missile Crisis? When that was all over the front of the newspaper, what do you think happened to the stock market the next week? It didn't actually affect those companies, but it brought fear, didn't it? And fear usually translates to the stock market dropping. What about something like the Oklahoma City bombing? What do you think it did right after that? What do you think about Pearl Harbor getting bombed? Dropped. And those are the things we're afraid of when we start thinking about taking risk. I mean, what about 911? Oh, man. It definitely dropped. I mean, the stock market closed for several days. Wall Street is right adjacent to the World Trade Center. There was dust and rubble everywhere. Plus, the president didn't want the markets back alive right then because people were scared. He was afraid they were going to just go crazy and the market would tank. And so to calm everything down, to get everybody's pulse rate down, the market stayed closed for several days. When it reopened, we in the business all knew that the stock market, as soon as it opened, and you didn't have to be a stock market expert to figure out after the World Trade Center, after the towers come down, right? What's the stock market going to do when it opens up? What's it going to do? And it did, didn't it? Does anybody remember? Boy, in mere minutes, it dropped 500 points. It went crazy. All the newscasters going, oh, the world's coming to an end. Whoa, 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 woo, people are panicking and pulling their money out.
So these geopolitical events are typically a world or a political event or disaster that negatively affects the stock market. And examples Dave's given so far, assassinations, Great Depressions or recessions, wars, 911, which is September 11th. Hurricane Katrina could be another example, so natural disasters as well. And Dave is mentioning the study that looks at what happens to the market after one of these geopolitical events negatively affects the market. And here's what he finds out.
Here's some interesting stuff, though. This study right here that I'm holding in my hands that I was telling you about with those major events studies what happens after a disaster 1 year later. Where is the stock market? When one of those things happens, goes down, where is it a year later? Of those things I named you, not counting 911, that's a different story, but of those other things like the Pearl Harbor, Cuban Missile Crisis, JFK assassination, Oklahoma City bombing, Kuwait invasion, all kinds of other things you could list down through here. There's about 10 or 15 of them on this. Out of every one of them here, within a year, the stock market returned to where it was within 1 year, every single time except Pearl Harbor. And it took it a couple of years to return, because Pearl Harbor was off the tail end of the Depression, and we kind of got our tails kicked the first year of that war. It took a little while to get some tanks built and go kick some butt, okay? That's really what happened, wasn't it? If you know a little bit about history. And as soon as that started happening, the market started coming back, and we started winning again. So bottom line is, a year later, it was history. On 911, here's what's interesting. The day before the cowards attacked New York, on the day before, the Dow Jones Industrial Average closed at 9,605. 9,605 was the Dow Jones Industrial Average on 9/10. Of course, when we reopened, I just told you, it went and everybody freaks out, and it's all over the news. Did anyone hear one newscast when 59 days later the Dow came back to its pre-911 level? It closed on 11/9/01 at 9608. It was down for 59 days and came back. One of the worst attacks ever on American soil, and the stock market took a 59-day sleep off. Did you hear one newscaster say that? Not one. It doesn't, if it bleeds, it leads. It's not the sky is falling. But see, what I'm trying to tell you here is the American economy is very resilient. It's resilient against war. It's resilient against the attacks by cowards. It's resilient against anything like that, to the point that almost every time within a year it's come back, and in 911 it came back in 59 days. So it's a pretty safe thing to say, as a group, American companies are a really, really good place to have your dollars invested.
So again, even when a geopolitical event negatively has affected the stock market in the past, it has come back within 1 year to where it was previously during this event. So the stock market is very resilient, and it's a great place to invest. So the next thing we want to take a look at is, how do I invest in the stock market? When should I buy stocks? When should I sell stocks to make money? What is the process? There are two terms, a bull market and a bear market, which will help us understand this.
A bull market is when everyone at the same time tries to rush into a certain stock at the same time and heightens up the stock market price on everything.
A savings account for livestock.
Something that you're confident in marketing something in the stock.
I don't know, maybe something in Spain.
I think of a bull market, I think of just a big, snotty bull just coming right at me.
So to reiterate, that bull market is when stock prices and the stock market is on the rise because a bull attacks up with its horns. And if you've ever actually been to Wall Street, there is a bull statue outside of it, and it's now got a little girl statue in front of it. And that's to show off that bull market concept. Versus a bear market is when the stock market and stock prices are on the decline as bears swipe down. So if you're looking to invest in stocks, your goal is to buy when it's a bear market. So you want to buy when the prices are low, and then you want to sell when it's a bull market or the prices are high. And the way you can figure out when this is happening is by looking up your stock based on its stock ticker symbol. And so this picture is a little example of that ticker tape that'll run sometimes at the bottom of a news program. And so that ticker symbol is usually 3 or 4 letter abbreviation that you can use to look up how your stock is doing. So I love Target, and if I type in all of Target's name here, it will tell me that the ticker symbol is TGT. So I could be looking at that specifically if I wanted to figure out how Target is doing. When I look up Target stock, it'll tell me a couple different things. Right now it tells me the first thing down here is that it is traded on the New York Stock Exchange, and it's currently going for $72.94 a share. This is up 30 cents today. How exciting. Go Target. Woo! And you can also use this to look up the history of Target. So here's the day. Here would be 5 days, a month, 6 months. So if I look at the year to date, we'll see that Target started off kind of low. It's been going up, 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 up. If I look at 5 years, we'll see that way back over here in 2014, it was down, it got a big peak, then it went down again. And we can look to some of those geopolitical events for why these would be happening. So if you recall, Target went through that major credit card security breach, and that was probably why we're down right about here. And then it's back up, and then it went down again. They closed a bunch of stores last year, and now we're coming back up in the new year. So this is one way for you to figure out how the stock is doing, when you might expect a bull market or a bear market. And again, you want to consider those geopolitical or world events or trends that may affect its stock and the reason why the price would rise or fall. And your whole goal would be to buy the stock again when it's low and then sell it when it's high so that you would make money based on whatever the difference there was. To get you practicing this a little bit, I want you to work on the 3-5 evaluating stock prices assignment. If you take a look, I'm having you come up with 5 different companies you've purchased from in the past and then evaluate that company's stock prices. So when I bought my new car, I bought it from Toyota, so I looked up the Toyota Motor Corporation. Here's its stock symbol, and it's sold on the New York Stock Exchange. At the time I did this, it was selling for $98.64. And then I want to know a graph of its performance in the last 5 years. And you're going to come up with your own 5. And then I want you to kind of look at the graph and explain why those fluctuations might have possibly happened. And then answer for me, would you or would you not invest in this company? One last word of advice is that not all companies are what we consider public, and public is when they are traded for stock. So certain companies are private. For example, Quick Trip is a private company. So if I tried looking up Quick Trip right here, I'm going to see that it says it's private. It does not sell stock. And so I can't look that up and I can't use that. So you're looking for publicly traded companies to fill out this 3-5 evaluating stock prices worksheet.